Now, let's talk about appointment of auditors. Before audit can begin, a client needs to get an auditor. Yeah. So, but who is allowed to be an auditor? So, which means auditors' eligibility is extremely important, because not anybody can just be an auditor. Yeah. Who is allowed to be an auditor? So I cannot just sit down here and say I'm an auditor. Every person that wants to practice as an auditor must go through minimum qualifications. I must have some minimum qualifications and registered under approved body. So to be allowed to perform an external audit, an individual must go through an approval process. Yeah. And what are the approval process? Depending on the areas where you are practicing, but because this is an ACCA paper, so the focus is on, say, UK. Yeah. So you must be registered and a member of ACCA for sure to be an auditor. Yeah. That is very, very important. Extremely. You cannot be an auditor if you are not a chartered accountant. So what this means is that you must be a chartered accountant. If you are not in the UK, maybe if you want to practice, say, in Canada or in US, you're definitely going to have CPA. So very important, and you must be a registered member of that association, right? Yeah. Likewise, you cannot, if you are an auditor, then you must not, see, I said must not that even cannot. You must not be a director employee of the client you want to, or even an associated company of the client you want to audit. So must not be director or staff of clients or associates. Never. Yeah, it's not allowed. And likewise, you cannot be a business partner. Not allowed. So you must be ACCA, but must not be any of this to be an auditor. If you don't satisfy any of these three, you cannot be an auditor. So, but if you satisfy all of this, which means you're allowed to be an auditor, then now let's talk about your appointment. Which means you are now eligible, but how do you get appointed? So talking about your appointment, who is going to appoint you? Shareholders do the appointment. So shareholders choose the auditors that they want. This is done by shareholders. Please take note. It's done by shareholders, and once the shareholders approved, they are also the one that will do remuneration. They decide how much they want to pay. They approve the fee to pay to the auditors. Yeah. Very important. So now the clients have decided to take you as the auditor. So follow this like a story so that you take it step by step. Right. So now that the shareholders have decided to appoint you, now definitely they will contact the auditors and say you have been appointed. Now that you have been contacted, the question is, should you accept that offer? Can you accept that offer? Remember, the client is done at this stage. Now it's about the auditor now. Because the fact that you have been contacted to come and do an audit does not mean that you must do the audit. And that is why we're talking of regulations and framework, because all these things are guided by the ISAs. And these are the requirements. What must you do as an auditor before you can accept the job? That is what we want to talk about now. And the first thing in your client assessment and professional clearance is to perform some basic checks. The first one is your assessment. I'll call it client assessment, because you cannot work with every client. If not, you will lose your license. So you must do client assessment and what we call professional clearance. So you must perform client assessment and professional clearance, because there are a number of issues that auditor must actually consider before agreeing to do that audit. So you do this, which I will explain. The second group of activities you must do is agree terms and conditions, T&C. And this is done on the engagement letter, which we'll speak about. And this is guided by ACCA 210, just to note it down for you. Start seeing some ACCA numbers. Yeah. So in the first group of activities, this is group 1. Yeah, there are 2 groups of activities that you must do before you can decide to take the audit. So group 1 is client assessment and professional clearance. Because what you want to do there is to ask yourself whether is it safe. So group 1 activity, yeah. What you're trying to ask yourself is it safe? Is it safe to audit this client? Is it safe to audit this client? Can we do it? Do I have enough resources? So let's start listing it. Is it safe? Because if the client is into drugs, is into terrorism, is into criminal act and all of that, you cannot associate with those kind of clients. Yeah? So you're asking yourself, do we have resources to do the job? Yeah. The credit rating of the client, is it good enough? Because if the credit rating is bad, maybe the client will not be able to pay the fee, because you cannot do a job where you are not able to collect your fee. It's not acceptable. You're asking yourself, will client be able to meet up with deadline in terms of providing all the resource, the information that you need, the data and information you need? You are checking the integrity of the client's management and directors. Yeah? Money laundering. Is it something that client is doing? Because if the client is into money laundering, you must not get involved in that client. You cannot audit that client. So these are the things you'll be doing when you are doing your client assessment and professional clearance. And I'm going to tell you what you do in professional clearance. In professional clearance, what you are actually doing, let me quickly touch on professional clearance. So this one, you are doing an assessment. Yeah? Assessment here. Yeah? This part. Now you need to also do professional clearance. Professional clearance is very straightforward. What you are saying is that since I am not going to be your first auditor, this is usually how you do this when you are not the first auditor. So it's not the first time that client is asking for audit, which means that someone has been auditing that client before. So what you are doing in professional clearance is to speak to previous auditor. So you are contacting the previous auditor and you're asking them why did they leave the client. So you must get clearance. That's why it's called professional clearance. You must get clearance from the previous auditors. Because if the previous auditors left for a very terrible reason about the client, maybe they discovered that the client is into fraud or money laundering or illegal activities and all of that, then you too, you cannot do the job. However, please take note that you must get consent of your client before you speak to their previous auditor. You must always get consent because of confidentiality. You don't want to breach that. So you must get that comfort and consent from your client to speak to their previous auditors. If they don't want to speak to their previous auditors, then you cannot take the job. But if they give you the permission to speak to the previous auditors, you need to speak to the previous auditors. If the reasons is good, then you continue to do the engagement. But if the reasons is bad, then you cannot do the engagement. So before you take up any engagement, remember there are two things you must do as an auditor. There are a set of activities that I've said are in group 1, which is client assessment and professional clearance, which we have mentioned as group 1 items, which includes ensuring that it's safe to do the client, the way of resources, credit rating of the client, integrity of the client, check that they are not engaged in money laundering. Then you do professional clearance, which is about speaking with the previous auditor. The second group of items to do is in accordance with ACCA 210, and that is agreeing terms and conditions. So for the group 2 items, which is accepting or agreeing, let me call it agreeing terms and condition. And this is divided into 2, and please take note of these 2 things that must be done. There are 2 things here which must be done. The most important one, both of them are very important, and they are very popular in exams, is to, number 1, confirm that preconditions exist. So preconditions of engagement. Now I'll tell you what those preconditions are. They are mandatory. Preconditions for audit must be present, and you must sign engagement letter. So what are those preconditions? Let's quickly talk about the preconditions, which are critical. The preconditions. Number 1, you must ensure that the financial statement you want to prepare that you want to audit has been prepared in line with international financial standard, a recognizable financial reporting framework, which is IFRS for ACCA. If you are in US, that'll be US GAAP, depending on where you are. So whatever is prepared in line with financial reporting framework. Like I said, e.g. IFRS, right? That's number 1 precondition. Number 2 precondition is that management knows their responsibility. So management must acknowledge their responsibility, which means they know their responsibilities. Responsibilities. And what are those responsibilities of management? That's preparation of FS. Auditors don't prepare FS. So preparation of FS, number 1. Number 2, they must put internal control in place. All of this, we'll look into them in details, what internal control is and all of that. And number 3, they must provide unrestricted information to auditor. Please take note of these 3 responsibilities of management. So they must acknowledge those responsibilities. Very important. So these are the 2 preconditions, that must be present before you take up any engagement. And the second part of the second group of activities must be done before you take an engagement is signing of engagement letter. Engagement letter is just the contract between, so this is a contract between auditors and the client. Client is the company that we want to audit, remember, right? So they must sign the contract. And you do this to reduce misunderstandings, and at least you have a legal basis for payment for that service, because the service that auditor is rendering, so the terms and conditions of that service must be documented in a paper called engagement letter, and that must be signed by both the auditors and the client. And it's extremely important that you know the content of that engagement letter, because it's also examinable. There's a minimum content that must be inside, and there are 5 of them minimum that must be there. You can have more things there, but these 5 items is mandatory. They must be there. The first one is the objective and scope of the audit. Must be there. So objective and scope must be there. You must state out the responsibilities of both the management and the auditor. So there's going to be responsibility paragraph. Yeah, both auditors and directors. The nature of audit work. Yeah. Whether it's going to be substantive, detail, control testing. So nature of the audit work. Yeah, must be summarized there. There'll be a paragraph for that. There'll be a paragraph on fees, because the service must not be done free of charge. It must be done at a proper, reasonable fee. And also, the report format must be communicated well ahead of time, so that it's not when we are done with the audit, then the clients will say they are not happy with the report format. So that is critical, and that is it with pre-engagement. Those are the activities that must be done. Yeah, we're still looking at the preparations and audit framework and all of that. We have not gone into planning. And quickly, we need to speak about corporate governance. You need to know about corporate governance, because it's something you need to also look into as an auditor. Clients with good corporate governance are good clients. And while you are doing your work as well, if you find issues with corporate governance, it might be telling you a few things about the audit risk. And maybe you might also have to provide some kind of recommendations to your client on how they can improve their corporate governance. What is corporate governance? Corporate governance is just the way a particular company is being directed. That is what corporate governance is all about. And who are the people that direct the company? They are the directors, because the shareholders are not involved in day-to-day management of the business. The directors have been appointed as the agent to work with management to move the company to where the shareholders want. Whereas those guys also have their own objectives. Shareholders have their objectives. The objectives have to be aligned for shareholders to achieve their own, right? So, but what are the things you want to see to give you confidence that the directors and management are working in line with the shareholders' objective? And in order to achieve that, there's a popular UK corporate governance code, which you're expected to know, because this is the popular one in your material. Different companies, different jurisdictions can have theirs, but this is quite popular, and you'll see that they are not so far apart. So you're expected to know this. There's OECD as well, right? But our focus will be on the corporate governance code, which is the UK one. And this is divided into 5 pillars in terms of what you expect companies to have to say best practice for corporate governance. 5 pillars. The first pillar is the board leadership. I'm going to summarize it for you quickly. So board leadership is the first pillar. And when you're talking about board leadership, you're talking about directors must be able to set the business model for the company, and likewise the strategy for the company. And that gives direction. The company must have mission and vision. That gives direction to the company and the management, right? So that's pillar 1. Pillar 2 is about the composition, evaluation, and succession. So this is talking about how committees are nominated, how there have to be annual election of all directors. The chairman should not spend more than 9 years, and there has to be an evaluation of directors at least once in 3 years. At least that once in 3 years must be done by external evaluator, but at least there should still be annual normal evaluation by that can be done internally or by maybe internal audit or another committee, right? But at least once in 3 years there has to be an external evaluator. So if I just summarize that quickly, so there has to be this saying that we should have a nomination committee which appoints the directors and other committee members. There has to be annual re-election so that directors know that they need to be of their best behavior and performance, because they can be removed if they don't do well in their appraisal. Yeah, the chairman should not last more than 9 years to max 9 years. Another chairman should come after. Yeah, likewise, there has to be evaluation. Yeah, so like an appraiser. The same way staff are being appraised, the director should be evaluated. Yeah, annually, but once in 3 years by external party, as an independent party. You can get a consultant to do that, right? Yeah, so these are things that auditors will look out for to be sure that they're able to conclude whether the corporate governance is good, which might also tell on the control environment of that particular company. The pillar 3 is the responsibility division. Responsibility division. And what does this mean? This is just talking about the fact that we should have at least 50% of directors, which must be non-executive director. Yeah, because these non-executive directors are the independent and very experienced people. And likewise, the role of CEO and chairman must be separated. So no one person must be CEO and chairman. So CEO and chairman must be different people. Very important. This is one of the reasons why Aaron, which is arguably the biggest scandal in the corporate governance space, we have the same person as CEO as chairman, right? So a lot of manipulation took place and no independence. The pillar 4 is the risk, internal control, and audits. Yeah, this is very important. This is pillar 4, and this is looking at being able to do risk assessment. Yeah, you might have a risk committee who is doing risk assessment. There must be internal control. Expect directors to put internal control in place. And likewise, audit must be done. And audit meaning both internal and external audit. Both of them. Yeah, and this is where we'll also speak about the role and benefit of audit committee. Yeah, audit committee. Audit committee. This is a big topic and very important, which I will take in subsequent video. The 5th pillar is remuneration. The directors will not do this service free of charge, in as much as they're not supposed to be overpaid, but at the same time, we need to remunerate them. And we'll be talking about the role of remuneration committee here and alignment with executive director. Yeah, and you need to understand that remuneration is important. So we'll talk about remuneration committee. Yeah, their function. Yeah, we'll talk about the executive director and non-executive director, how they are being remunerated reasonably, such that there's no pressure for them and they're able to deliver their roles and responsibility accordingly. Yeah, quickly I will speak about audit committee, which is the most important thing here. Yeah, so this is a summary of the 5 pillars of UK corporate governance, which you must know. Try to summarize a key concept for you there. But let's talk about audit committee, which is very, very important. So audit committee is one of board committees, yeah, which is very critical for every business. In fact, a listed company must have audit committee. It's mandatory. You are not allowed to not have audit committee because their role is so critical to the survival of the company. And usually they are expected to have at a minimum 2 independent non-executive director. Yeah. So let me put it this way. So what you expect is this is a board committee, like I said. It's a board committee. Yeah. And in terms of composition, you expect that the board should have members minimum. So greater than or equals to 3 members. That's minimum of 3 members. And out of these 3 members, you must have minimum of 2 non-executive independent directors. Please take note. Very important. And why do we need audit committee? Roles of audit committee. Yeah, they are the one that they appoint external auditors. In fact, external auditors, they appoint the external auditors. They fire them as well. If they need to disengage, they are the one that will fire them. They are the one that will remunerate them. In fact, audit report goes to them. They review audit report as well. So the external auditors reports, they review the external auditors report, because the report is submitted to them first, before it goes to the shareholders. They are also involved with internal controls. They are expected to put internal control in place. They supervise internal audit as well, so not just external audit. Audit committee also supervises internal audit, right? So they supervises this guy. They establish control. Please take note, right? Very important. And also, they provide oversight on what we call independent reporting platform, like whistleblowing platform. Whistleblowing. You know what whistleblowing is? When things are going on in the company that is not right, that is not ethical. There should be a platform where anybody, either staff, can anonymously expose the company or the directors that they are doing something unethical. Right? So all of these are the roles of audit committee. And if you look at with all those roles, how do those roles benefit the company? The major reason why it benefits the company is because it gives confidence. Let me even add here as well. So they also review the financial statement. So they provide oversight on financial reporting of the company. Because of all of those functions, they give confidence to users of financial statement. They improve the credibility of the company. So they improve the credibility of the company. And also they provide independence. To shareholders. Well, let me say they provide independent view, because they are mostly non-executive directors, so they are able to provide that independent view to the shareholders. But they are well trusted because of their level of experience and the fact that they are also very independent and they are not staff, they are not executive directors. So with that helps the company to get that credibility, confidence on shareholders. Very important. Those are the benefits of having the audit committee.